My most difficult problem is just getting a response from VC, venture capital, to get to a call. There are multiple layers to this challenge that we need to break down. Let's define VC. And let me give you a little bit of a definition term so you understand where I'm coming from, which is going to help you process this information. Venture capital is a subset of private equity that is involved with alternative assets, highly risky assets called startups. Therefore, private equity invests in everything from boring companies like manhole companies to service-based organizations that would never attract VC, infrastructure, real estate, etc. And then private equity is a subset of just the investment community in general. So there's always going to be an investor that wants to invest in something, and these might be called the angels. There might be retail investors who invest in stocks. And then private equity is the organizational layer. It's the institutional layer that has gone through the regulations, and they could be registered investment advisors, right? RIAs. And a lot of VCs are turning into RIAs because private equity, they can buy stocks, they can take companies and take someone's money and say, we're going to buy a piece of this company and put it together, do all sorts of investment activities. Venture capital is a subset because private equity said, we don't want to touch startups. We are not interested in writing a check $1 million to a founder that has never shown any traction before at an early idea stage for the potential to go 100, 300x. We're not going to write a check to Uber or the Airbnb guys in the beginning because that's really dumb. Who the hell wants to rent a couch from a potential axe murderer or get into the back of a car where someone's going to drive you, harvest your organs, and dump you on the side of the road? Nobody's interested in that. But if it works, it's a unicorn. It's worth billions of dollars. And if you would have written $100,000 or $300,000 check to Airbnb or Uber in the beginning, you are worth literally like $1 billion back in the day. That's how early you got in. Private equity is not interested in that. So then VC comes around and they say, all right, so now we're going to write checks to seed companies. Everybody listen, pre-seed, the majority of our founders are in pre-seed. Pre-seed was not a thing. It was not a thing until about 2015-ish. First dot-com bubble, pre-seed was not a thing until it got to 2009 was the subprime mortgage meltdown. 2008, 2009, and then capital started getting cheaper. And so there's a lot of money. And initially, seed checks were like $250,000, $300,000. That's it. We're watching pre-seed checks, pre-seed of $20 to $30 million today. And all these founders tell me, well, the average pre-seed has been $500 to $1.5 million. Yeah, I get it. But that's in a really interesting time of the ZIRP environment, zero interest rate policy environment. So then what happens is all this capital sitting on the sidelines and it's cheap, nothing to borrow. It doesn't cost me anything. So I might as well put it into something. I've got lots making me money over here. So I'm going to get into riskier assets. Then VC says now deals are getting more competitive. I can't get into Ubers or the Airbnbs, just like people can't get into the open AIs right now at a good price. So what do? They start going earlier into the cycle of founders, and they say we're going to now invest in something called early stage, which everyone calls pre-seed now, which is the wild, wild west. There are some VCs that are pre-seed, micro VCs, accelerators, incubators, angels, who might be your grandma who bought Bitcoin at $300 and wants to YOLO some money in because she loves you. You're a rich aunt or uncle that exited out of some real estate or finally decided to cash in their stocks because they're planning their legacy. That could be an angel and they're interested in startups. They don't know the difference. Hence, give you this long explanation to understand that every investor has a different investment thesis, everyone. That's what it boils down to. And therefore, what you may think will get the attention of one VC is not necessarily the case, but may get the attention of another VC or get the attention of an angel investor. And that's why to get attention from VCs, you have to define what a VC is to you. I call it founder funding fit. You have to define what investor fits you, what investor fits your stage, and what investment thesis they need to have. And you have to go research. There may be a perfectly good reason that you're not getting attention from those VCs because you don't fit their investment thesis. On top of which, they may be full of shit. I'm just telling you right now, 90% of investors right now that are out there promoting are not actually funding. You may be thinking, whoa, Ed, wait a second. They're saying they're investors. I understand that. But right now, we are in nuclear winter, and you have to understand how VCs work. They're looking at deals, but they're not funding because they don't have enough dry powder, or they're just trying to show an activity because VCs don't make money off of investing into you. They don't. They make money off of taking money from investors that are LPs. So they may just be kicking the tires and saying, we're looking at pitch decks right now and going through the motions because they need to look busy, or else their LPs are going to go, what are you doing? But they don't have the money to invest. It's very possible. And I know I might be just totally disillusioning a lot of people, fabric tearing before your eyes, the fabric of reality. But this is the game, everyone. So do you stop talking to VCs? No, because you don't know who has money. Like I said, I talked to investors yesterday. I said, how much dry powder do you have? Qualifying question. How much budget or how much can you actually spend? And he was like, $2 million, but I'd be willing to part with $1 million. I said, okay, we're talking about $1 million. You know how many conversations I have to have with investors? Do you know how many angels come to me and say, can you give me deal flow? And I want to invest. And I say, how many checks do you want to write? How much? They say I have $300,000 and I'm thinking about writing like 10 checks for $30,000 a piece. And then I send them deal flow, totally goes to the founders, nothing. Not legitimate. I have to qualify those people. Yet founders seem to come and think anybody who says they're an investor, they're going to invest, they're going to write me a check. That's not necessarily the case. So it might not be your fault. That's the first thing. Second thing, let me rant and rave just a little bit more. You may not want a VC. You may be better suited for angels. You may be at that stage where you need an angel. You need a little bit of angel money to get you over the hump, get you to the next step, and then you'll attract VCs. Your startup may not be ready to go full-blown VC funding, because if you want to take $1 million, they expect you to turn that into $100 million of value, which equates to $10 million in revenue within 5 years, I would say, probably less. Look at the mathematics. I call this traction math. I have a video, LinkedIn posts, everything. One of my more popular posts of recent note. You have to be able to 100x in terms of valuation, the value of their money. So if you're asking for $1 million, you should be prepared to be generating $10 million and prove that you can do it. That means if you don't have an attraction short term, they're not going to believe it. $10 million with innovative technology, that is a 10x valuation. That's a $100 million valuation. That's how they will get their funds paid back. Because a VC will say every check that we write needs to basically 3, 5, 10x our fund completely. So if they have $100 million and they write you $1 million check, you need to go out and be able to grow that startup to $300 million in valuation. And most founders can't do that math. Most founders don't have a startup that can do that. Therefore, you're not looking for VC. Maybe you're seed strapping, or maybe you're looking for an angel investor who's happy with a 15% annual return in terms of an annuity payment. Maybe that's what they're looking for. They're just looking for a dividend. They just want 15%. Or maybe they just want their money back plus 15%, and it's a convertible note. You may be trying to talk to the wrong VCs because your startup is not either ready or suited for their type of investment. The final level is you just might be completely, I'm going to use the word with all affection in the world, you might be in denial. Might be in denial right now. My job is to get you through the 5 stages of grief so you become better founders. Once you can handle the grief of being the founder, getting punched in the face 10 times a day and getting up every single time, you'll be a better founder. There's a phrase out there saying being a founder is like chewing on broken glass and starting to like the taste of your own blood. That sounds really masochistic. There's a pathology of being a founder. We're all sick in the head in some form or another, because being a founder is not the best thing for your career, making money, anything like that. Only do it because you have to do it. When young people come to me and say, should I become a startup founder? I say, absolutely not. No way. No way. Don't become a founder. Only do it if you cannot not be a founder. You can't help yourself and be a founder, because this journey is crazy making. It's insufferable, especially if you're trying to do a unicorn startup that exits and becomes the next Airbnb. Again, all of you better than 0% chance. You might not be prepared to go through all the 5 stages of grief you'll experience raising money, but I'm going to help you. First stage, denial. I'm totally investable. I'm totally fundable. Why would they invest in me? I totally have enough traction. I totally have an idea that nobody else is doing. No other way to say it. Next is anger. VCs are stupid. Ed is stupid. Do you know how many founders I have who are stuck in the anger stage and they blame me? They tell me, Ed, it's because of you I can't raise. Because of your pitch deck, because of your advice, because of the time I spent with you, I wasted it. I can't raise. They do this all the time. Startups.com sucks. They leave us bad reviews, all those things. That's the anger. It spills out onto other people or the investment community, and they become bitter and they get stuck there. How to help you through that? Next is the bargaining. Well, maybe if I drop my valuation, or maybe if I do this, or what if I offer this, etc. How do I kind of move the pieces around? Doesn't matter how much lipstick you put on a pig, it's still a pig. You're not going to be able to bargain your way out of an uninvestable startup. A startup that is not fundable, you can't bargain your way out. It's like rearranging the chairs on the Titanic. That's why you go through denial and you get through anger. And I have no problems taking the hits. I've had founders just call me bloviating. They've used words. Literally, they just come on and say, Ed, you're a piece of shit. And I say, great. Thank you for letting me know. You're right. I probably am. Right? I just take the hits. Once they get through bargaining, I have to let them down. I say, you can try it. And they keep trying it. Then they get to the depression or the sadness stage. I'm a crappy founder. That's when I get to step in and say, you're not. You're not. There's so many other factors that are out of your control. Let's stop wallowing. But I'm glad you're getting there because that gets us to the last stage, which is acceptance. Once you get to the acceptance of the reality of being a founder, especially if you're raising money from VC, you will be a better founder. Because once you've accepted it, that is the turning point for courage. When you've accepted it and you have the courage to accept the reality, you have the courage to change. You have the courage to go out there and get traction, the courage to go out there and work on your pitch deck, go through all those miserable pitches and get rejected over and over again. You get through those 5 stages of grief, you'll be more resilient as a founder, and that is my job. And that's why I say, maybe you're not getting VC attention. And I'm not saying this is the founder in this case that graciously posed this question for us to discuss today or for me to rant. It's a one-way discussion. I'm standing on my soapbox ranting. But maybe, just maybe, it is designed to get you through the 5 stages of grief to become a better founder. It's not happening to you. It's happening for you. And I know I'm getting all woo-woo personal development, but maybe that's the case.